Okay, I believe we're now at webinar number 3. To recap what happened in the last webinar, we were attempting to start off, or I should say I was attempting to start off talking about the method of accounting for tax purposes, and in so doing was going to use the Form 1040 as a point of departure for that. When doing so, I wound up discussing what it's like to do tax preparation, and which is a good thing because we should talk about that at some point during the semester, and so we have and will do some more. And that leads me to going back to the method of accounting that taxpayers use. For all intents and purposes, taxpayers use the cash method of accounting. Let's take as an example, before we go to some forms that are going to be pertinent to our discussion, let's take the following example, which will be the source of polling question number 1 for this webinar. If a taxpayer is being paid a salary as an employee, $10,000 a year, $10,000 a month, or $120,000 a year, their salary is expected to be $120,000 for the year, but not unlike most employer-employee relationships, the employee works for a while and then gets paid. So you might work for a week and get paid after the week. You might work for 2 weeks and get paid after the 2 weeks. The cash method basis of accounting is what you follow for salaries, interest, dividends, just about everything but business income follows a cash method. Even the employee wages, even though that's arguably a trade, as in the term trade or business, it's business income, it's business reporting, where the method of accounting becomes statutorily more confusing because for all other income, or basically almost all other income, as I'm saying, you follow the cash method basis. So let's get back to the employee example. Again, $120,000 a year salary, $10,000 a month, and to make it easy, the employee gets paid at the end of every month $10,000. Obviously, with taxes taken out, the net payroll check will be less, but the gross wages is $10,000 at the end of every month. So he starts the job for the first time January 1, 2014. Gets paid $10,000 on February 1st for the month of January, and so on. And so the question will be, how much income does that person report, and how much income will be reported on the W-2? The W-2 is going to follow a cash method basis of accounting as well, and you'll figure out how much wages that person should have. In the problem, it'll say that they were paid $10,000 a month at the end of every month on the first day following the month. So the key is going to be what happens in December of 2014. They'll work for the month of December, and the December paycheck will be dated January 1. So strictly speaking, the W-2 will read, and that's going to be the source of the question, at least the source of it anyway. Okay. That's cash method. When it comes to business income, as I was saying, what happens is that the statute gets involved. And so when you are talking about a business, the Internal Revenue Code is going to have something to say about it. Let's talk about that. First of all, before we even get to a discussion of it, there is a motivation on small to medium-sized businesses to be able to and want to report on a cash method basis of accounting. There's a high motivation for it. One arguable reason for it is because it is a simpler method of accounting. When you get involved in the accrual method basis, you are now well seasoned in the accrual adjustments that have to be done to properly adhere to generally accepted accounting principles, which follows an accrual method of accounting. So there is a incentive for small to medium-sized businesses to be able to use, if they can, if the law allows them, to use cash method. The second reason could be it's a little bit easier to manipulate. We had some examples in class when we were talking about constructive receipt of income, the doctrine of constructive receipt, how we manipulated reporting income on a cash basis, and the same can be said for expenditures. At the end of the year, if you are showing more income than you would care to pay taxes on and you're a cash method basis of accounting taxpayer, then you just write some more checks. We oftentimes tell our clients when they want to know what they should do for year end, we just say, well, take a look at how much money you have in the bank and start writing checks. So, and prepay expenses. Prepay as many expenses as you can afford to do so. And that in the year before the end of the year, if you do that prepaying for next year's expenditures, the deduction will be in the current year, and you'll get a tax deferral. Not a tax savings, but a tax deferral, because you're moving up the expenditures into an earlier year than would otherwise be allowed under accrual accounting income. All right, so that's the reason for the motivation of wanting to do a cash basis method. Here's Schedule C, reporting income from a sole proprietorship. Let's just take a look at it for purposes of tax preparation, see what the form's like, fill out the sole proprietorship, his name. If he has a particular business, product, or service, we put that down there, and the name of the business and the business address. Notice that there is a code that corresponds to the type of business it is, and the neat thing about tax software programs is that they'll have the codes embedded inside the program. You can look it up in there and it'll do it automatically for you. That's really one of the cool features about these programs. They often link you either to IRS instructions or they link you to some type of tax service that will explain in more detail if you have questions while you're preparing a return. So you can almost sit at your computer, never leave your desk to get all your answers while you're preparing a return, and just and life is beautiful and sedentary because of all the modern conveniences of these programs. Okay, so then you come down to line F, where it tells you, or it asks you, this is really a question, what kind of an accounting method are you using? And you'll check the box, cash or accrual or other, which we'll discuss in a second. Pardon me. The first year of a business, and this will make a second good polling question, the first year of a business is the year that the business makes a couple of important elections. And there are probably two, and they're probably in this order. The first most important election is what type of business entity to be, whether you should be a sole proprietorship, an limited liability company, or a corporation. The first year that one is in business, that's when you make that decision. And of course, that decision sometimes can be changed later on. But when you first start, that'll be probably the most important decision you'll make for at that time of the business. The second most important decision will be what method of accounting to use for your books and records and for your tax purposes, your tax income tax statement. And that's why you see this line F. If this were the first year and you were needing to make the election as to whether to report on a cash basis or accrual basis, you're first going to have to look to the statute to see what you're allowed to do. And if you are allowed to check cash and you decide to, then you'll check cash. And by checking the box, that's how you've made your election. That's how you tell the IRS, my election is to be a cash method basis of accounting business, and by checking the box here, that my election's done. I don't have to do anything else. I don't have to attach any specific statements or forms. The election is done just by checking which box you're going to follow here. Now, the rest of the schedule, we're going to cover line G later about the material participation. and see, it says if you started the business, you're supposed to check there. That way they know this is new. That's line H. Line I. Yeah, line I is interesting because it segues from our discussion last webinar number 2. Notice what it's asking there. This is brand new, relatively speaking. We didn't always have this on tax return. The reason for it, question I, is did you make any payments requiring you to file Forms 1099? And then they want to know if you did you make them? I mean, you have to be, I guess you'd have to be a little bit naive to think that you can check the box for line I, yes, we made payments requiring Forms 1099, and then check J as no. That's that's like inviting an audit. That's what we call it, inviting an audit. If you were to check H as yes, we did make payments requiring Forms 1099, but we didn't do it, and we say no, well, shame on you. So these questions are, I think, obvious that they're trying to get taxpayers to comply with the various numerous and complex requirements for the Form 1099 series. The more reporting under the Form 1099 that gets done, the easier a job the IRS has in matching up income between taxpayers and the forms that were prepared and filed, and it just makes their job easier to make sure everybody's reporting the proper amount of income. And that's what this is all about, to alert taxpayers that there is this requirement. If you were going to say, oh, I didn't know that I had to do this, then now the return is causing you to know that it is a requirement because you have to answer these questions. And if you're really naive, I'll now reveal to you one of the reasons why the compliance is low. In small business settings, it's not unusual to pay people on the books and off the books. On the books would mean I'm paying you a salary, you'll get taxed on it, this is how much I'm going to pay you, and then I'm going to pay you and I'm not going to record part of it. I don't do that. So when I say me, I'm not talking about me in reality. It's an example. I don't do it, really. I don't. So you may be told you may have a job someday. You may have already worked someday someplace where they told you we're going to pay you part of your salary or all of your salary off the books, for crying out loud. And when that's done, what they mean is they're not going to report it on a 1099 or a W-2. And so the issue is what they're trying to get here with, particularly in the construction world with subcontractors. Subcontractors are known to go, in the small business world, they're known to go to places of establishment where they're going to work, doing a subcontract work in the work of whether it's cement work or woodwork or electrical work or plumbing, and they'll say they'll be asked their price. How much will it cost? Well, they'll say it'll cost you $1,000, but if you pay me cash, it's $800. Well, why? Because if you pay in cash, they don't have to report it on their income tax return. Nobody knows about it, and so they can choose not to report it. This isn't a course on tax fraud, but the reality is this is what goes on. So these questions here are designed to try to bring this into compliance. The IRS is using the taxpayers and the tax preparers, because we have to answer these questions for the taxpayer when we are preparing returns. So we're going to have to ask, did you do this? And if the answer is no, our next step will be to advise the client, well, if you did pay and you were required to file Form 1099, let's talk about the consequences. And the consequences could be that if you get audited, you'll receive a fine, a penalty for each Form 1099 that you didn't file. You'll find that the payment that you made, quote, under the table, or however you want to call it, that you're not reporting will not be deductible because you didn't file the Form 1099. So all sorts of negative tax consequences can occur if somebody gets audited, and we'll go through that and try to get them into compliance with these rules. The rest of the form follows just what you would expect a profit and loss to follow. We've seen it before. The couple of differences is that depreciation we are now learning. We certainly touched upon the fact that depreciation expenses according to tax tables, specific tax code sections that tell you how to depreciate certain classes of assets, not according to generally accepted accounting principles where we choose the estimated life of a product and sometimes have salvage value. For tax purposes, it's strictly by the book. If it's a building, depending on what kind of building, this is what you do. If it's furniture, this is what you do. If it's a car, this is what you do. You just find what you bought, find the applicable class life, and follow MACRS, the Modified Accelerated Cost Recovery System, and you depreciate it according to those tables without any deviation, and it makes life simpler when it comes to deciding how things get depreciated. Also, another nuance is that on line 24B, you'll only be deducting 50% of your meals and entertainment. At least the majority of those expenses will be subjected to the 50% limitation, and so that'll be a difference between the book's income and the tax income on this Schedule C. Now, here's the source of, I don't know if it'll be a polling question, but I'll mark it down as a possibility. You keep books and records for a business, and the tax code, in its infinite wisdom, will often refer to you'll follow the books and records. You'll follow the books and records. For example, when it comes to the method of accounting, the tax code simply says you should follow the method of accounting used by the books and records of the company, of the business. Well, that's very cool, except very typical of the tax code, they never define what it means, books and records. So does it mean a general ledger with debits and credits the way we know it? So tax court has decided over many decisions that it does not mean that. Any methodology of keeping records such that they would be accurate enough to file a tax return will be acceptable as books and records. We, of course, as accountants, would encourage all of our clients to follow a double entry bookkeeping system, as it has been proven for over 500 or 600 years to be the best proven way to record business transactions. So I don't think any of us would suggest that we have a client use an Excel spreadsheet, not in a debit and credit format at least. But nevertheless, books and records from the Internal Revenue Code standpoint does not necessarily mean double entry bookkeeping, because they didn't define it, and the tax courts have decided that any reasonable method is satisfactory. So, tax code says your method of accounting for tax purposes should follow the method of accounting that you use for your books and records. What if you are a business that you're a small business, you'd love to take advantage of the cash basis method of accounting for tax purposes, but you really want to know what your business did on an accrual method basis of accounting, because your accountant has told you that's the golden rule, meaning the golden code of computing net income out of a business, the income recognition and matching principles under accrual method is a tried and proven best way. So you say, okay, so we'll keep our books and records on an accrual method, but we'll report on a cash method. So as we've just heard, that the tax code says, no, you have to report on the same method you use for your books and records. And that has, over the years, many, many years, caused a lot of issues. And so eventually things got fixed up, where back in 1968, a taxpayer advisory memorandum, or advice memorandum, I think that's what it stands for, taxpayer advice memorandum, came out and basically said, as you can see here, that if the accrual method was used, but you have sufficient reconciling work papers to show how you go from accrual to cash for tax purposes, that's okay. That's like keeping your book, that's like reporting based on your books and records. It's been accepted And this is actually, and this could be a good polling question, even though it's probably not in the textbook. It's probably not a bad one for you to have some idea as you get into tax departments within the public accounting world. The particular work papers that is referred to in this paragraph is called a lead sheet, L-E-A-D, a lead worksheet or lead sheet. And the lead sheet basically means it leads you from the accrual to cash, or it could go the other way. But that's the idea. It would say, here's our accrual numbers. To get to cash, you take out the receivables, you take out the payables, etc., and you get to basically a cash basis. So it's the conversion from accrual to cash or back the other way is what is a lead sheet. That's what a lead sheet is referring to. Okay, so let's talk about the methods of accounting allowed. Cash receipts and disbursements are allowed under the code, accrual methods, and then what they call a hybrid. And we'll describe a hybrid in a second. Well, maybe not a second. Soon. We'll describe it soon. Well, let's do it now. I like doing it now. Let's do it now. So suppose you have a business that you can use cash method for, but the business has two divisions. One division is the division where you can use cash method. The other division is a division where, according to the Internal Revenue Code, you're supposed to use an accrual method of accounting. And let's talk about a real example of how this works. The typical one and the most famous one, basically, is that if you have inventory, the Internal Revenue Code and the IRS has said, come on, guys, if you're selling inventory, accrual method is the only method that makes sense. To do that cost of goods sold and that gross profit with the beginning and ending inventory, that's it, man. That's good accounting, that's good record keeping. To start trying to fool around with, I'll just buy more inventory at the end of the year and report under a cash basis and not have any adjustments for beginning and ending inventory, that we know that doesn't make any sense. That would be taking advantage of, that would be manipulating too much. So if you have an inventory-based business, accrual method is generally what the tax code is going to say you have to do. If you don't have that, if you have services, then you get more flexibility, more availability to use the cash method. So back to our case. We got a business, got two divisions. One's a service division, and you guessed it, one's a inventory sales division, selling inventory. So the hybrid method says, all right, what you can do is for the division of the business that's service, go ahead and report on a cash basis. On the inventory side, you got to use accrual. So you're basically splitting up a business. That's basically what the hybrid method is talking about. All right, now, one cool thing for small business owners is that the tax code allows businesses that are doing gross receipts of $1 million or less, and certain businesses of $10 million or less can use cash basis. But let's focus first on the million, which could be another good polling question to go through that. The million small business guy who's doing $1 million or less, he could even have inventory, and he can still report on a cash basis. That's the key here. It's the key, of course, it could be any kind of business, and for $1 million and less, he can stay cash basis, but he could even have inventory, and he can still report on a cash basis. And of course, I suppose motivating reason for this part of the code is small business guy can't afford to have a sophisticated inventory system. Give him a break, let him report on a cash basis. That's cool. Certain businesses with less than 10 million in gross receipts can use the cash basis, and those would be businesses that are not involved in inventory. They're not involved in inventory, so those businesses can report cash method all the way up until the point when they get to 10 million. And when they go about higher than 10 million, then the general rule is they've got to go to a accrual method of accounting. Again, same principle. You're getting beyond small business when you hit 10 million. you're already getting into medium-sized business. Let's face it, accrual methods is the best way, so that's the reason for changing that. However, even cooler is the fact that there are even a few exceptions for that. And the one I want to concentrate on that's pertinent to us, well, I guess it's not pertinent to us because all these are, we're not going to do farming, but most farming businesses, it's good to know. If you wind it, it's a good specialty to get into actually because there are not too many accountants who understand all the nuances involved in the farming world. But most farming businesses can report on a cash method. Again, being kind to the farmer, I suppose. And then these types of corporations get a break. Qualified personal service corporations, which are consulting services, lawyers, doctors, accountants, dentists, personal service, they can report on a cash basis all year long, and no matter how big they get. Under the corporate form, when they qualify as a personal service corporation, as defined in the Internal Revenue Code. All right, so we probably don't need to know that for this course. I don't think it would be fair to ask it, but let's take a look at one topic that I think is pertinent. Let me just see where we're holding in terms of timing here a minute. See if I can tell. Let's see. Where are we holding? Does it tell me? It doesn't exactly tell me. I'll tell you what we'll do. We'll take a break, and we'll come back where we to where we are. So I'm going to stop here, and we'll come back.